The Meaningful Money Handbook by Pete Matthew. Everything you need to know and everything you need to do to secure your financial future. Before you start the journey, it helps to understand the wealth building mindset. Getting rich slowly is the best way. Building wealth deliberately and carefully leads to good habits that will serve you well on your journey over the long term. Get your head in the right place before you start. Pete refers to 3 steps to financial success. Spend less than you earn, insure against disaster, invest wisely. The first of these 3 steps is spending less than you earn. This forms the foundation for all that follows. Get this right and the rest will fall into place. Living below your means is vital for wealth creation. Most of us have some form of steady income that we rely on every month, and we need to be in control of that cash flow in order to balance the books. Get a budget. Budgeting isn't tracking spending, it's telling each pound where to go. You need to control your money or it will control you, and by setting up a budget, it will quickly highlight any areas of weakness and stop you from falling back into bad money habits. Get out of debt. Good debt carries a low interest rate and is used to buy things that increase over time, such as mortgages, investments, and education. Bad debt involves high interest rates and is used to buy things which decrease in value over time, such as cars, credit cards, and payday loans. Pay off these as soon as possible. Pete's take on student loan debt in the UK. The student loan system in the UK is unique. Firstly, monthly payments have nothing to do with how much you have borrowed. It is paid back based on your income, currently around 9% of money earned over 25k. This means that if you are out of work, then you won't need to make any repayments on your loan. Secondly, interest rates are linked to inflation. Therefore, for many people, the amount owed in real terms won't actually increase that much. Finally, any money owed after 30 years will be wiped off the slate, so effectively, the student loan debt is more like a graduate tax. Many won't get anywhere near paying off their loan, and those that do will have earned more anyway. How to get out of debt. Establish a starter emergency fund of £1,000 to cover any emergency expenses. Pete recommends paying off the bad debt with the snowball method. Line up your debts from smallest to largest and pay the minimums on all debts and throw everything else at the smallest debt. Once this has cleared, continue to the next smallest loan and so on until all debts are cleared. Once you are free of bad debt, then build that emergency fund out to at least 3 months of expenses. There is no correct amount of money to have in an emergency fund. Whatever lets you sleep at night should do. Pay yourself first. Saving what's left at the end of the month never works. Therefore, use your budget to pay yourself first by allocating your savings and debt repayments to be taken out by direct debit the day after payday. Step 2. Insure against disaster. Even when you are in control of your finances, there are lots of things out of your control that could happen, such as dying early, being diagnosed with critical illness, or being unable to work due to an accident or illness at work. All of these can have a huge negative impact on you and your family's finances. Therefore, it is important to mitigate the impact of these events through insurance. Pete suggests establishing the right kind of cover for your needs and to determine how much cover you need and then put this in place. Make a will. If you were to die or become incapacitated in some way, then you want to know that the process of sorting things out is simple for your loved ones. Get expert advice and get a will in place. Pete goes into further detail in his book on this section, so if you're interested more on this subject and want to read further, then I've linked to his book below. If you use this link, I'll get a small commission at no additional cost to you, and this will support the channel so I can continue to create free content for the viewers. Now that you have got a solid foundation in place, it is time for the fun part, investing. Investing can be overwhelming when starting out. There are lots of questions to figure out as a beginner investor. How much to invest for the short term versus the long term? ISA versus pension or both? Gold? Bitcoin? Pete explains that most people only need to do a few things consistently and they will have an enjoyable and successful investment journey. Saving versus investing. Saving is short term, is done by putting money into a bank and is risk-free and struggles to keep pace with inflation. Investing is long term, involves buying assets such as shares, bonds and property, involves risk but will grow your wealth over the long term. Cash is not an investment. Any money in your emergency fund should be kept in cash. Anything else that is not required in the short term should be invested. Investing comes with risk, and risk comes in different forms. Inflation risk, the process of prices increasing over time. Just ask your parents how much they bought their first house for. The reason we need to invest is so that your money can grow more than inflation. Longevity risk. The risk that you might outlive your money. A lot of people don't take enough risk with their money, meaning that the pot doesn't grow to a large enough size to last their whole life. Investment risk. In a diversified portfolio of assets, this refers to how volatile the asset is, or simply put, how much the value will move up and down over time. Behavior risk. No matter how volatile an investment is, you will only lose your money if you press the button and sell that asset for less than you purchased it for. The way we behave around money is probably the biggest risk of all. Risk and reward are linked. In the investing world, more risk is accompanied by potential greater returns. Risk tolerance and capacity for loss. How will you react to market moves, and how much money can you afford to lose? Pete recommends doing a risk profile questionnaire to discover this. Risk can be managed through the following. Diversification, which means spreading your money around across different geographical locations and different asset classes. Investing over a long time period. Also, risk can be managed through reviewing your investment portfolio regularly to make sure that it doesn't drift too far from its original intention or asset allocation. Asset classes. There are a variety of asset classes such as cash, bonds, shares, and others such as property, gold, commodities, etc. I've covered these in another video, so I won't cover them in detail here, but the main driver of returns is how much you allocate to stocks versus bonds. The most important factor is being in the market. Pete says it's time in the market, not timing the market, that counts. Funds. Most people buy assets through a fund, which is essentially a pool of investors' money that is combined to allow you to buy a portfolio through purchasing just one fund. Passive versus active. Take the FTSE 100, for example, which consists of companies like HSBC, Vodafone and BT, etc. An active fund manager would look at those 100 companies and try to select which specific ones they should hold in an attempt to produce superior investment performance. A passive fund would just buy shares in all 100 companies, which is an intention to achieve the performance of the market on a whole. Active investing requires research, skill and luck. It also usually comes with large teams of highly qualified, highly paid analysts and fund managers that are experts on these companies. This naturally comes at a higher cost. Academic studies show that choosing passive funds removes the risk of choosing the wrong manager and is cheaper. Over the long term, only 1 in 100 active managers outperform the market. Therefore, Pete recommends that most ordinary investors are best suited by opting for a passive strategy, as this is cheaper and easier. So which tax wrappers should I buy the funds in? Pete recommends that you get your free match from your workplace pension and then choose how much to allocate between pensions and ISAs. ISAs should be used for shorter term goals and pensions for longer term, as you can't access your pensions until later in life. Identify your asset allocation based on your risk profile. For example, a more risk-averse or older investor would hold more in bonds and cash, and a younger and more risk-tolerant investor would allocate more to shares. For most people, Pete recommends that this should be done using a multi-asset, off-the-shelf passive fund to keep it as simple as possible. Follow these 3 steps and you're on the path to securing your financial future.